Welcome back. We are watching the 18 Money Show with me, Kavita Thapliyal. The Indian stock market have been on a bull run recently with benchmark indices hitting record levels. While it has brought cheer to an otherwise volatile market, it has also given rise to skepticism, with many people believing that stock markets will fall automatically. So is correction in the markets imminent? To answer all of these questions, we are joined by Sudip Bandyopadhyay, Group Chairman, Inditrade Capital. Sudip, good evening and welcome to the show. We usually don't discuss market movements on this show because we do that throughout the day on the channel. But then talking about a personal finance show, it's definitely related to market and its movements. So we want your help to help our viewers understand the end of 2022 and the beginning of 2023. All right, to start off with, what are the triggers on which the market is actually navigating now?
Well, I think a few factors, Kavita, I'd like to highlight which the investors need to be aware of for navigating Indian markets at this stage. I think the first point is the GDP growth of India. It's been kind of brought down by a few notches by IMF, World Bank, as well as RBI. But still it is around 6.7%, 6.8%, depending on whose estimate you go by. And remember, this is still probably the best GDP growth for a country of a reasonable size, barring Saudi Arabia for the current calendar year and or fiscal, whichever way you want to choose to look at it. Now, in an economy, in a world where economic growth is gone into a negative territory for most of the European countries, marginal or zero in the US, significantly lower in China, Japan, and other developed countries. I think this kind of economic growth is what investors will look at while investing in a country. The second point, again, I will make here is that remember during the last 4 or 5 years, emerging market funds have raised significant amounts from investors, and these funds were supposed to be and have been deployed in the emerging markets of the world, which is predominantly Brazil, Russia, India, China, BRIC, as we know. Now, look at what is happening in Brazil. A left-wing president has come to power. Russia, we all know, is in the midst of a war with Ukraine, and hardly any sensible fund manager will have any investments in Russia. China, we know what's happening in China as far as multiple sectors are concerned. And a lot of investor wealth has been decimated in China. And there is a tendency for global investors to move money out of China and significantly reduce exposure. Now, all this liquidity will, in one way or the other, try to find heaven in India. The third and last factor is that Indian companies, also if you look at Indian companies by and large, whether you compare with 2008, 2014, or even 2020 when COVID hit us, I think Indian corporates are in pink of health. The balance sheets have been streamlined, unrelated assets have been shed, and the cost ratios or let's say the margin performance has significantly improved, whether you compare with 2018, 14, or even 2020 beginning. Now, under these circumstances, I think Indian market still warrants attention and still will continue to attract investments from global investors, ensuring there is significant liquidity and consequently the capital market will retain positive bias.
So let's go on further and dissect this, because even though we can see slight sluggishness in the growth, in the growth trajectory so far that's been presented, what do you have to talk about, say 2 to 3 quarters from now on? Because even though we are on a very strong footing right now, but then global headwinds are still a big concern. We are also talking about recessionary and economic slowdown kind of an environment which will impact us, and most importantly the health of corporate India. So far that looks in a very good health, but going down for 2 to 3 quarters, do you think that will be a bigger concern for us, and that's something we really need to track?
Well, I think we need to be cognizant of a couple of factors which will affect India in the next fiscal as well as next calendar. One factor is India's over dependence on oil imports. Now, we know the geopolitical problems are not behind us, global geopolitical problems, and that can at any point of time lead to flaring up of crude oil prices, which does affect India adversely, both economy and the markets. Now, this is one big factor which one has to be cognizant of. The second, and I think you alluded to that, there is a definite slowdown or recession in some of the leading economies of the world. Europe is probably heading into a recession. US is at a very low growth or nil growth, and many other economies of the world are suffering. Now, this will definitely lead to slowdown in Indian exports. Now, there is no two ways about it that in a global economy which is shrinking or not growing, Indian exports cannot grow, it will shrink. So we will have challenges on the export front, and we may have challenges on the crude oil front, which can upset the fiscal balance. Now, under these circumstances, of course, our arrangement with Russia, whereby we are able to procure crude oil at a lower price compared to Brent crude prices, is definitely a good way of cushioning the shock. But I think a couple of other things we need to remember. One is the fact that domestic inflation is to a great extent imported, except for the food inflation bit. Now look at what is happening as far as food inflation is concerned. It has already started coming down, and we believe that with the arrival of winter crops, it should come down further. And that's what the RBI has been alluding to in their commentary. And if that does happen, the pressure on RBI to increase interest rates further will go down significantly. And we have seen the first part of that story getting played out during the recent credit policy announcement by RBI. Now that does create a positive environment for Indian corporates when interest rates don't keep going up on a regular basis. And maybe at some point of time during the next fiscal, interest rates may start again stabilizing and maybe coming down also. That does augur well for Indian corporates. But yes, I would accept one point of what you are making, is that we have to be a little careful in picking up stocks. We believe that companies which have significant business and exposure in Europe and US, we need to be careful of, at least in the short term, short to medium term rather. Whereas we should look at companies having domestic business, domestic consumers, and which are dependent on domestic economy's progress. I think careful stock selection will be the way forward as far as next calendar year and next fiscal is concerned.
Sectors are you looking at? I mean, we really have to have a very cautious approach in picking up stocks, but then what kind of sectors you think are going to outperform ending 2022 and entering 2023?
Well, one sector which we believe will outperform and hasn't yet moved up that much is the construction and infrastructure piece. Private capex, after a long gap, has started picking up. We believe public expenditure will also start picking up very soon. Remember, there is a central election 18 months down the line, and governments, both state and central government, have a lot of unspent money which they need to spend on capital expenditure. So Indian construction and infrastructure and cap good companies will do well. They have already started moving up, but I think this trend will continue. So one can look at companies directly in this sector, or even companies like cement, building materials, and other related areas. This is one area which is a completely domestic economy focused sector, and we should look at that. We should also look at FMCG. I think we did see a little bit of slowdown in FMCG due to rural consumption and rural demand coming down on account of rural stress. But I think the first signs of rural stress going away is there, visible for us. And as things start improving on agricultural crop arrival front, we will see rural incomes going up and FMCG companies coming back and starting to perform exceedingly well. Also, that's a safe and steady sector for investors to be in. So I think I would recommend, apart from construction, infrastructure, building materials, and related stocks and cap good stocks, one can also look at FMCG for a safe haven.
All right. I think that will be all as far as the time is concerned. I mean, we can go on discussing about the markets and its movements for almost an hour now. But then, all in all, in nutshell, as people you always ask us, do you think this is an all-time high of the market, or this kind of a high also implies that there will be a fall very soon? So, is there an answer for this question?
Well, of course, there is an answer. We can't comment on short-term movements of the market, and we may see some correction, some profit taking at some stage. Particularly, remember the month of December. Normally, the trading volumes come down after 15th of December significantly, and we may see some profit booking. But the reality is, if we look at a medium to long-term or even a one-year outlook, the way we understand the markets, I think Indian market definitely has a positive bias, and new highs will be reached definitely in the next fiscal as far as Indian capital markets are concerned. Whether we will touch 22,000 or 25,000 is in the realm of speculation, will depend on a lot of other extraneous factors, including crude oil prices. But by and large, we will maintain our upward trajectory on a medium to long-term basis.
All right, Sudip, thank you so much for being on the show and talking to us and guiding our viewers make a strategy in this current market moment. We'll slip into a short break, but then post that, let's do your live financial planning and get your portfolio answered from Hemant Tustagi.